Hi, thanks for joining me today. I'm Teresa with PegaFund, and today we're going through the top 5 reasons businesses fail from poor cash management. Revenue is vanity, profit is sanity, cash is king. Cash is the lifeblood of your business. You can be profitable on paper and still have a negative cash flow, meaning you're spending more cash than you're bringing in and your bank account is going down. One thing to clarify is cash runway does not equal cash flow. For example, you could have your funding lined up with a cash runway for 2 years, but just because you know you'll be profitable in December, if you can't pay your bills in January, you're dead in the water. You need to know if you have any cash risk and how to mitigate that risk in advance. Reason number 1, businesses fail to assess the business reality. Even the best cash flow management won't help you if your business fundamentals are out of whack. Questions to ask yourself. Do your financials reflect your business reality? Do you have an understanding of your business's unit economics? For example, does the simple act of providing your service cover its own cost and help cover your overhead fixed costs? Do you have an understanding of your business's cash burn and runway to operate? Now, how do you get that clear picture state of your business's reality? You should be closing your financial statements on a monthly basis. This includes preparing a statement of profit and losses, a balance sheet, and a statement of cash flows. Questions to ask yourself. Is that bank balance going up or down? Do your day-to-day business operations, your operating activities, generate or use cash? How much cash are you spending on investing long-term in your business? Is it too much or too little? Is the money coming from operations, or because your business is taking on loans or from investors, from your financing activities? Having the clear picture, a really honest snapshot of your business allows you to find opportunities and mitigate the risks before a crisis situation. Reason number 2, businesses don't forecast their future cash inflows and outflows. When you're driving a car on a highway, you're definitely scanning ahead to make sure you're hitting the right exits and avoiding any roadblocks. Preparing cash flow projections is doing the same for your business. So, how do you do cash flow projections? Step 1, look to the past at your historical cash flows. Do you see any patterns or seasonality? Are there any points during the year where the cash balance is negative? Step 2, using that historical data, look to the future for the next 12 to 24 months. Now, forecasting is a science and an art. Each month, you want to look ahead at the next 12 months at a minimum. Depending on how much cash you have on hand, you may even want to get more granular and forecast the next 1 to 2 months on a weekly basis. You want to consider future sales confidence and expected payments from customers. How does this impact your cash in? Should hiring be slowed down or ramped up? You also want to consider your future spend. Step 3, assemble your cash flow projection. At the most simplified level, it's going to be your bank balance at the start of the month, plus cash coming in, less cash going out, and this will equal your bank balance at the end of the month. Now, your cash coming in is hopefully primarily from sales and collections on receivables. Your cash going out is going to be from bills, credit cards, payroll, rent, etc. Once you've prepared your cash flow projection, you want to assess the same things that you did in step 1. The biggest red flag is if that cash balance is negative, what is your plan to find the cash to keep your business afloat? Doing regular cash flow projections will lead to some great insights. Are you overspending or underspending in certain areas? Do you have a comfortable cash cushion? Or are there some red danger zones ahead that you need to circumnavigate? Reason number 3, businesses don't optimize their cash inflows and outflows. If your cash goes out the door faster than you bring it in, you'll find your bank account is in an overdraft position. So, how do you optimize your cash flows? First, you want to speed up your cash in. Are you invoicing customers on a timely basis? How quickly do you collect? How do you chase late payment? Is there an automated process? Is it manual? Or worse, is it not monitored at all? Can you offer customers discounts for early payment? Can you charge interest on overdue balances? Second, you want to slow down your cash out. Are you paying invoices back too early before they're due? Are you always late on paying invoices and therefore incurring fees? Can you consolidate suppliers so that you can negotiate discounts? Is all business spend actually appropriate? How do you ensure this? Do you control company credit card spend? Third, you want to continuously monitor your cash inflows and outflows. It's helpful to pull weekly accounts receivable and accounts payable reports into a spreadsheet, and then look ahead to forecast it for the next 3 months. You should also calculate your cash conversion cycle. The lower your cash conversion cycle, the better your business's cash generating position. Your cash conversion cycle is a pretty simple formula. Days inventory outstanding plus days sales outstanding less days payables outstanding. Now, for the purposes of SaaS companies, we're going to ignore the inventory piece of the equation for now. Let's say that company A's sales team takes 90 days to collect payments from their customers. However, company A's accounting team is super gung-ho and pays all their bills within 5 days, way before they're even due. You can see that it takes 90 days to get cash in versus only 5 days to get cash out. Company A's cash conversion cycle is 85 days. On average, it takes them 85 days to generate more cash. In contrast, Company B's sales team takes 45 days to collect payments from their customers, and Company B pays bills at 30 days. Company B's cash conversion cycle is only 15 days. On average, it takes them only 15 days to generate more cash. So you see, even setting simple policies or goals around the number of days it takes your company to collect from customers and to pay vendors can make a huge impact on your cash flow. VC funding is like a corporate credit card that you never have to pay back. That is, until your house gets taken away because you haven't delivered on time on your promise to investors before you maxed out the credit card limit. Knowing how long it takes your business to pull cash in versus push it out is critical. It can help you optimize your cash flow situation and even potentially become a competitive advantage. Reason number 4, businesses don't consider financing needs in advance. Failing to plan is planning to fail. A great quote from Alan Lakin. As part of your cash flow projection, plan your financing needs in advance and not in a crisis situation when bankers may be nervous to lend. Be strategic and apply for a line of credit before you need it. Qualifying for a line of credit is much easier when you're in good financial health. Banks will be more willing to approve you and to give you a better rate. Reason number 5, businesses don't have a contingency plan for a crunch time situation. Companies see banks with SVB and woke up one morning realizing that they had no access to any of their funds. What are some crunch time levers they could employ? Consider, could you offer big discounts to generate some quick sales and inflows? Could you offer customers an incentive to prepay or pay balances back before they're due to get some quick cash in? Could you negotiate with suppliers or landlords for extra time to pay bills? Could you offer to consolidate SaaS tools and vendors to get additional rebates and discounts? Amongst the founders, C-suite, and investors, who would be committed to contribute how much should a sudden cash call situation arise? It's critical to have a contingency plan to discuss and share with the founder or management team in advance of a crisis situation. The purpose of the discussion today was to focus on day-to-day operational cash management. It's really important to determine how many months worth of cash outflows you need to keep in your checking account. A business should always have a minimum of 6 months of cash runway. When you have less than that, you really need to have a tight handle on your accounts receivables and accounts payables to manage this. A business that is not profitable should never operate with less than 3 months of cash runway without a secure contingency in place. In fact, in certain countries in Europe, it's technically illegal, or at the very least will trigger a director's liability. So, what should you do with any cash that you're sitting on in excess of what needs to be kept in your checking account? What is your company's long-term cash management and investment strategy? Have you diversified your investment risk and even your bank? As you can see, there's some other long-term considerations for you, but to dig into that would be a whole other session. Spectacular achievement is always preceded by unspectacular preparation. A great quote from Robert H. Schuller. Strong cash management brings many benefits to a founding team. That cash is king mentality can really make or break a company. Adopting this mindset from the top to throughout an organization creates focus and opportunity. The cash flow tracking and forecasting process provides data and transparency, which is critical to decision making and leads to cohesive leadership. By identifying cash shortfalls and making contingency plans, in advance, provides you with optionality and many ready-to-go choices for when times get tough. If you'd like to figure out how well you're doing at cash management and where you are relative to your peers in this new environment, reach out to us. We have a great operational scorecard to provide you with that insight. Thanks for joining us today, and we'll see you at our next session.